Hello, I'm Edward Sterling, macro analyst for Bullion. Gold has a reputation as one of the safest assets investors can own. For centuries, it has served as a store of value during periods of inflation, currency debasement, and financial instability. And because of that reputation, many new investors assume that buying gold is simple. Find a dealer, buy some coins or bars, store them somewhere safe. But the reality is more complicated. Because while gold itself is a relatively straightforward asset, the physical gold market can expose investors to inflated prices, misleading sales tactics, counterfeit products, and products with markups that quietly destroy returns. And for new investors, these pitfalls are surprisingly common. So in this video, we're going to walk through how to buy gold safely, the mistakes investors make when entering the physical gold market, and how to avoid the most common traps that cost people thousands of dollars. Let's start with the most important concept every gold buyer needs to understand: the difference between the spot price and the price you actually pay. When you see gold quoted on financial news, trading platforms, or macro analysis, that number represents the spot price. The spot price is the current market value of gold traded in global financial markets. But when investors buy physical gold, they almost always pay more than the spot price. That extra amount is called the premium. Premiums exist because physical gold has to be refined, minted into coins or bars, transported, distributed through dealers, and sold through retail channels. All of those steps add costs. For standard bullion products, those premiums are usually reasonable. But this is where many investors run into their first problem. Some dealers aggressively push products with extremely high markups, particularly collectible coins or so-called rare coins. These coins are often marketed as special investment opportunities with historical significance or potential collector value. But in reality, many of them contain the same amount of gold as ordinary bullion coins, yet sell for dramatically higher prices. In some cases, investors unknowingly pay 30, 40, or even 50% above the underlying value of the gold. And when it comes time to sell, buyers usually care about the metal content, not the marketing story that justified the higher price. That means recovering those premiums can be extremely difficult. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Now, the next step in buying gold safely is choosing where to buy it. This is where experience in the precious metals market becomes extremely important. Most investors purchase physical gold through one of three channels. The first is large national bullion dealers. These companies specialize in precious metals and typically publish live pricing, transparent premiums, and buyback policies. Their reputation depends heavily on maintaining trust with customers. The second option is established online precious metals retailers, many of which offer competitive pricing and a wide selection of widely recognized bullion products. And the third option is local coin shops. Many local dealers have been operating for decades and can provide the advantage of face-to-face transactions and immediate delivery. What matters most is transparency. Reputable dealers display premiums clearly, quote, prices close to prevailing market rates, and allow investors to compare products without pressure. In contrast, questionable dealers often rely on aggressive sales tactics. Investors sometimes receive unsolicited calls warning about imminent economic collapse or urging them to act immediately before prices rise dramatically. These calls are often designed to steer buyers toward expensive products with large markups. A good rule of thumb is simple. If someone is pressuring you to buy gold quickly, that's usually a red flag. The gold market is extremely liquid. Legitimate opportunities rarely require immediate decisions. Now, another critical decision investors face is what type of gold product to buy. For most investors, the best approach is sticking with simple, widely recognized bullion products. These include coins and bars, produced by major government mints or internationally recognized refiners. Examples include 1-ounce bullion coins, such as American Gold Eagles, Canadian Maple Leafs, and other widely traded products. Standard bullion bars are also common, particularly 1-ounce bars produced by well-known refiners. These products tend to have reasonable premiums, strong global recognition, and high liquidity when it comes time to sell. That's important, because the easier a product is to recognize and verify, the easier it is to sell. Now, this brings us to another issue many investors overlook: counterfeit gold. While counterfeit gold is not widespread among reputable dealers, it does exist in secondary markets and peer-to-peer transactions. Modern counterfeit products can sometimes appear convincing to inexperienced buyers. Professional dealers use specialized tools to verify authenticity, including weight verification, precise dimensional checks, ultrasound scanners, and X-ray fluorescence technology. For new investors, the simplest way to reduce counterfeit risk is to purchase widely recognized bullion products from established dealers. Now, there's another warning sign investors should always keep in mind. If a deal looks too good to be true, it probably is. Gold trades in a global market with transparent pricing. Because of that transparency, legitimate opportunities to buy gold significantly below market price are extremely rare. When someone claims they can sell gold far cheaper than prevailing market prices, there is usually a hidden catch. That catch may involve counterfeit products, misleading contract terms, or hidden costs that only become clear later. Healthy skepticism can save investors from costly mistakes. Finally, investors should think carefully about how they plan to store their gold. Physical gold is valuable precisely because it is portable and durable, but that portability also means it needs to be stored securely. Some investors store gold at home using secure safes. Others prefer bank safe deposit boxes or professional vaulting services that specialize in precious metals storage. Each option has trade-offs. Home storage offers direct access and control, but may require additional security measures and insurance considerations. Vaulting services offer professional protection, but introduce storage fees. What matters most is having a clear storage plan before accumulating significant amounts of physical gold. Now, if we step back, there's a broader lesson here. Gold itself is not complicated. It has served as money and a store of value for thousands of years. But the structure of the gold market, premiums, dealers, product types, and storage introduces risks that investors need to understand. In many cases, the biggest risks in gold investing don't come from the metal itself. They come from how the metal is purchased. Understanding premiums, choosing reputable dealers, buying widely recognized bullion products, verifying authenticity, and avoiding high-pressure sales tactics can dramatically reduce the chances of making costly mistakes. Because when investors approach the gold market with knowledge and discipline, physical gold can serve exactly the role it has played for centuries. A durable store of value in an uncertain financial world. And that raises an interesting question. If global debt continues rising and central banks remain deeply involved in financial markets, will more investors begin turning to physical gold as a form of long-term monetary protection? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.